Welcome to Fidelity Soundbites, a monthly podcast where investors can tap into Fidelity's more than 400 investment experts who are on the ground around the world so that you have the inside edge when it comes to making more informed investment decisions. From equities to fixed income to private assets, let us help you build a better financial future.
Hello, my name is Lucas DePaube. Welcome to Soundbites, and I'm very pleased to have Matt Jones, Portfolio Manager for the Fidelity Research Global Equities Fund with me at the moment. Welcome back, Matt.
Cheers. Thanks for having me again.
Fantastic. And look, today we're going to have a quite interesting discussion because the market over the last couple of years has been quite interesting. There are some parallels with other periods, but if you think about what's driven the market over the last several years, it's been fairly concentrated, fairly unique. I mean, you've been in markets for well over 20 years. How do you sort of see the market over the last, say, 5 years? What have been the key drivers and what does that performance profile look like?
Yeah, I think the last 5 years actually been quite unique in the volatility and some of the rotations you've seen in the market have been quite large and extreme. And when you think of that from an investment point of view, an equities point of view, that rotation has been through things like big kind of factor bets and biases, value, growth, and more importantly, just as you alluded to, momentum. They've been very strong, some of these kind of drivers of performance, and quite unique in the presence that they have in the market and the power that they've been delivering to single stocks and portfolios generally.
And would you say that momentum, so if you sort of reflect on your time in markets, has it been stronger this time round than in other market environments?
It's becoming increasingly stronger, and we've seen that very evident, especially in kind of Asia-Pacific market in the more recent kind of weeks where we've seen kind of 6 standard deviation negative returns to things like momentum. But I think when I think about the last 5 years and even the last 21 years, I think when we talk about momentum, it's quite an interesting factor or character of stock markets. And I kind of refer it to as, like the wolf in sheep's clothing. So you think of, say, quality and growth or even value and things like this. And they're great kind of things to invest in when you look at a stock. But the problem is when it becomes too much investment in that and too much crowding and too much chasing that one individual thing, it literally turns into momentum. And that's kind of like the wolf. And the wolf will bite when it rotates like we've seen recently.
And you've seen a little bit of that. I mean, if you sort of drill down a little bit and, you mentioned sort of it's been a concentrated market. So if you look at the S&P 500, I think the top 10 stocks make up about 20% of the market. And a lot of that has been a lot of this AI tech-led growth type of companies that have really propelled that. And to your point, it's almost like a self-fulfilling prophecy when you've got this momentum driving stock prices up. How does that break down?
Yeah, I mean, it breaks down through a number of things. You see that crowding chasing the same thing, and then you see basically some fractures or some fundamental things in what's driving it break down. I think the problem with you think of momentum in a formulaic sense, it's kind of mass times velocity. We've got a whole lot of mass, you say weight in a couple of certain names, chasing this one thing very fastly, and that momentum picks up. All you need is a small break that no one's looking for, that no one might see, for that to fall apart. And currently you're thinking things like CapEx spending, how are they going to generate income from that? How are free cash flows? You think about the debt markets currently starting overnight. We saw the bond and the debt market starting to panic a little bit about all of these kind of things. And one of those things will eventually break and trigger that unwind.
So in this environment where momentum, along with other factors, but certainly momentum has been a strong factor driving markets, you've seen the index perform really well. So obviously the index, particularly when it's concentrated to some of these momentum-driven sectors, do really well. But we've also seen what we would call traditional quantitative managers. So managers that apply, I guess, a more of a mathematical model-based approach in terms of how they analyse the market. And typically those quantitative managers, most of them have an exposure to momentum as one of the factors they look at. And we've seen those funds do really well in recent times. I mean, you manage portfolios in a little bit of a different way, but how has that been a headwind for you? And I guess, what are the key risks of that?
Yeah, I guess you can break it down, that kind of question, into two things. So when you think about the benchmark and the index, they're cap-weighted. Cap-weighted is price times shares. Price is momentum. So when you see things run hard, naturally the benchmark will build a whole lot of momentum into a cohort of 3 or 4 possible names. We've seen that in the history of benchmarks, and then that rotates. Momentum unwinds to something else. When you think about quantitative funds and some more the traditional pure quant funds, they're coming from your Pharma French background. Pharma French breaks stocks down into momentum, quality, value, growth, these kind of basic factors. They follow those things. They try to time those things. and then you get maybe a bit too much crowding, and then you'll see that the fundamental breakdown of some of those factors and the unwind in that alpha generation. I think the aim is our aim is to try and build portfolios that don't have any of those big exposures and a bit more forward-looking in the nature of the alpha driver behind the input into your returns as well.
Yeah, it's an interesting one because, I think when you look at some of these strategies, and they certainly have a role to play in portfolios, but when you do have a momentum-driven market, a fairly benign market as well, those type of strategies look really good within the context of a broader portfolio. They look beautiful on a risk-adjusted basis, all of these things. But it does make me think, and back in my sort of previous roles in managing portfolios, particularly I remember before the GFC, where you saw a lot of these quant strategies look really nice in terms of the risk and return, and it's sort of unwound. So if we think about some of those risks, I think the risk of being concentrated in that one sort of or couple of these factor exposures is definitely there. So how would you sort of think about that from a broader portfolio perspective?
Yeah, again, it goes into the basically two things: the input into your portfolios, that alpha source that you're trying to deliver, and then the portfolio construction around that alpha source. I think the important thing is to ensure that both of those things are unique and independent, and when combined together, they provide you with a return profile or a return source that is uncorrelated to all of those types of things, and it has essentially more of a idiosyncratic exposure that's not driven by what everyone else is being driven by. I think it's important to make sure that you understand what's driving your fund and that you do have a diversified alpha source. It goes back to basics.
And if you think about diversified alpha sources, I know the way you approach portfolios is looking at our proprietary research, and that being the fundamental driver of alpha, but applied in a systematic way in terms of the portfolio construction. And in a world where data increasingly is becoming a commodity, how much do you think that access to that proprietary fundamental research is a strength and advantage in this environment?
I think it's immensely critical. Like when we think of the world of AI and the access to data now from everyone, to your mum and your dad on the street with ChatGPT and OpenAI and Anthropic and all of these things coming to market, it allows people to get access to these more generic kind of exposures and alpha drivers out there, value, growth, momentum, quality. I think what's very important is to have a unique data source that provides strong alpha that no one else has access to. And there's very few of those kind of data sets or alpha sources in the world. It's quite unique to have that here at Fidelity with 120 analysts over 50, 60 years of strong quality data of that alpha to deliver. It's very unique, and I think it's super important to have something that nobody else has. And the quality of that data also is extremely important.
And you mentioned, obviously, the qualitative nature, the breadth of that research. Again, you've done some interesting work looking at, over time, how much value just purely that research can add. Any insights there that you wanted to highlight?
I think the most important thing to think about, say a fundamental research team, especially like what we have at Fidelity and that provenance and the history of that research team, is that it's not that they're not looking at things like momentum and value and quality and things like that. What you've got is that human interaction, that human input, where it takes that data and is much more forward-looking than your traditional backward-looking factors. And what I've seen over time when we've analysed, the alpha generation from our research team globally, it is really persistent across time, across different regions, and very uniquely uncorrelated to what we see out there in the alpha that can be generated from other things outside of our team here at Fidelity.
I guess there's also a pragmatic element to it, because you can have something which no doubt you could see on your screens, looks nice from a quantitative perspective, ticks a lot of boxes, but you can speak to an analyst and get the bird's eye view of actually what's happening there. And I know in the past you've sort of given a couple of examples where things may look on a screen from a quantitative perspective, but to get that insight, I guess pragmatic, fundamental insight can be high value. Yeah,
it is. And it's that uniqueness of speaking to, let's call it a human being, an individual that's taken all of that historic information. They're looking at a rapidly changing market that's not picked up in any of that data, and then predicting of what will happen into the future. You don't get that from your more traditional, back-tested, quantitative-looking models. When things rapidly change, like in the current market now, and there is no history of that change, then you need, that human being, that kind of, let's call it I look at all of our analysis of my own little multi-factor quant models, looking forward to work out whether that stock's adequately priced given market conditions. That's from an alpha point of view, but also from a portfolio construction point of view. Markets break down, you get large systematic shocks, and the models you might be using from a factor point of view get shocked rapidly. And you don't want to trade off that information in immediate terms. You want to digest that information, slow everything down, and make sure everything's a bit more stable for the future.
And when you bring it all together, I mean, your approach is unique because you are leveraging those fundamental insights from the analyst team. But then you are constructing a portfolio in what we would call much more of a systematic way as well. Can you touch on a little bit what you mean by that systematic approach to portfolio construction?
Yeah, it is quite unique. So we are literally taking the output from a human being doing deep fundamental research. We quantify that in certain ways, and then we build a very repeatable, consistent process around that. And I think that's the most important thing, a very strong, repeatable, risk-aware construction process. So we're trying to eliminate some of those big factor exposures, those market timing bets, and uniquely deliver that purely systematic kind of proprietary alpha that we have at Fidelity. I think it's all about making sure that you've got a robust, disciplined process. So when the client comes to you to say invest in what you're doing, they know the outcome they're going to get every single day. There's nothing hidden there. There's nothing under the bonnet that is going to be scary or pop up in the future and lead to some drawdowns.
So, Matt, we've talked about the research and the research team. I'd be interested to understand the efficacy of that research because, people could say, we've got research, but what makes our research unique and different? And, you've been with the business for a long time. What has your experience been in terms of the efficacy of that research?
Yeah, and it is an interesting question when you want to think about the core alpha to what I do and what we do at Fidelity. And I think it is quite unique and differentiated in the structure of the way we do things at Fidelity. Having been here since kind of early 2005, I've been using the output from our fundamental research team to generate alpha through many different cycles. From the European research team and running European portfolios to UK-centric portfolios to global, developed world or country world, long, short. Generating alpha has been relatively consistent and persistent through all of those types of lenses and experience I've had through the last kind of 21 years. But I guess what it comes down to is a core of what we do and what we've been doing since 1969. This is a very well-known house. It's not easy to become an analyst to get here to start with. And when you're an analyst here, you've got hundreds of eyes on you from different portfolio managers to heads of research. And your key job as an analyst is to generate alpha and deliver that alpha to clients, essentially. And my key job as a portfolio manager is to capture that alpha. And it's that history and provenance and that depth of data and research that we have around doing that is why the alpha source is so consistent and repeatable. I think ultimately on top of all of that, again, going back to one of the points I just made, is our analysts are paid to outperform. They're paid to outperform and beat the markets to deliver that to clients, which is very different when you think of out there in maybe sell-side world where a lot of your job is to market the research rather than deliberately, specifically generate alpha.
So, Matt, we've talked about the research and the quality and depth of that research, but from a practical perspective, how do you consume that research? How do you take a report with a recommendation and bring that into a portfolio, into something tangible?
There's a quite interesting question, and it's quite important to understand how you take that breadth of research. Let's think we've got 2,500 ratings, maybe 1,200 buy ideas. How do you shrink that down? I think it's focusing on the key outputs from the research team. Like you said, the research note. Is it simply a buy or a strong buy? They run their own model portfolios. So if I've got 10 stocks on a buy, I can look at their model portfolios and go, well, what are your 3 best ideas in the portfolios that they're measured on? And then ultimately, too, it's reading the research note and speaking to the analyst. Read the research note. Is there conviction in their thesis? What are some of the outliers that might happen to that stock? What are the positives? What are some of the key negatives? And then drilling it down from those kind of broader ideas from the quantitative output from the research team, reading the research note and focusing on what is your highest conviction idea that I can get into our funds.
And I know one of the things you look at also is the recency of the rating. And when we've spoken in the past, that recency and the rating is an important factor in terms of determining the sort of efficacy of the research.
Yeah, and it is. And this is how you can kind of quantify output from a human being and make it better and more deliverable in that alpha you get from things. So, our analysts have to publish research notes regularly, very regularly. I think the important thing that we do in our process is make sure that if I'm adding capital to a new name or I'm looking to increase capital to an existing name, is has that analyst published a full research note, say in the last month or two. And this is very important in rapidly changing environments because I want to make sure I've captured all of that information very, very quickly and it's not delayed in how I can deliver that to clients and their portfolios.
So if we think about the last couple of years, and we touched on this in the beginning, you've seen a very narrow market in terms of what's driven performance in some of those tech names. You've seen things like momentum, for example, play a big part in driving markets, which has benefited your index players as well as your traditional quantitative strategies. And if we look ahead, your process is an interesting one because it's a bit of a hybrid process. It is accessing a unique alpha source in terms of the fundamental research, but applying that in a more systematic way of portfolio construction. How does that fit in the context of your more traditional, say, quantitative or index strategies?
Yeah, I think it is a unique moment in the market to make sure you do focus on portfolio construction, and that's what we do strongly in the processes that we run around our research team in what I do. And I think the focus of our portfolio construction is to deliver that idiosyncratic alpha. So what does that mean? It means we make sure that we look at this fund on a daily, weekly, monthly, quarterly basis and ensure that we don't have any big bets or exposures. We don't have any big momentum bets. We don't have any big market cap bets. We don't have any big AI or factor type bets or anything we can't see. And with strong portfolio construction and strong oversight that we do have here at Fidelity across many different parts of the business, we're able to keep an eye on that and to ensure that we're delivering, that kind of pure idiosyncratic alpha. So we won't get kind of hit if there's some large rotations out of some of these big exposures that some of our peers, like if you're following the benchmark or if you're following momentum or if you're following growth or quality, will have in their portfolios. We're trying to deliberately avoid that and make sure we, in portfolio construction world, we're focusing on that pure idiosyncratic alpha.
So if I think of that from a portfolio perspective, I sort of look at that and say, for your listeners out there saying certain things have done really well over the last couple of years, things like momentum, which is great, but be aware of what your exposures are and make sure that you are diversified, because just being exposed to a very narrow set of factors, great while it works, but when it reverses, you could be overexposed.
Yeah, and that's exactly when I talk about momentum being that kind of wolf in sheep's clothing. It's great when it works for you, but the minute it rotates and that wolf comes out, that's where you're going to feel some pain.
Fantastic. Well, Matt, thank you very much for your time, and I look forward to speaking to you again.
Cheers. Thank you.
If you've enjoyed today's episode, make sure to subscribe to Soundbites on your favourite podcasting platform. Otherwise, if you'd like more information on Fidelity or Fidelity products, please head to our website at fidelity.com.au. Now for some important information. This podcast is issued by Fill Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only, has been prepared without taking into account any person's objectives, financial situation, or needs. You should consider the product disclosure statement and target market determinations for Fidelity Australia products at fidelity.com.au. Please click the link in the show's description to read the full disclaimer.